All right, Devina Mehra is with us. She's a market master of the day, founder, chairperson, and MD at First Global. Devina, it's a pleasure. Thank you very much for joining us here on CNBC TV 18. Prashant here. So let's just start with the big talking point, which is the sort of global easing cycle, which has been kicked off by the Fed with an aggressive 50 basis point cut. What does it mean eventually? Not actually, eventually, probably the wrong choice of word because it's kind of very long term. But what does it mean in the medium term for flows into emerging markets like India? Because this has been a domestic equity story. Local investors have pumped and pumped and pumped $4 billion a month into mutual funds now, whereas foreigners have been reluctant. Will that change as rates start to come off in the Western world?
Good morning, Prashant, and good morning to your viewers also. So analysis of the Fed 50 basis points cut is different because they actually just said that if we had known the data earlier, we might have cut 25 basis points in July itself. So it's really a combination of the two cuts we should have done. So it doesn't necessarily mean that they will cut it all the way down to where they started from. That's unlikely because, if I was the Fed, I'd like to keep some powder dry that in case the economy needs it. As of now, it doesn't look that the US economy particularly needs a boost. So that's as far as the US is concerned. As far as the liquidity into emerging markets or to India is that part is concerned, as I have said plenty of times, I think must have said on your show also multiple times, that if you're trying to project how much FPI or FII money will come in, but and obviously the assumption behind that is that the more money comes in, the market will go up. If money goes out, market goes down, or at least there's a correlation. But if you actually look at the data, there has been historically no correlation. And that is even at a time when the domestic flows were not of this kind. In fact, the domestic mutual fund industry did not exist. So FII money started to come into India around 1994. And 1994 to 2003 has been the only 9-year period in the Sensex history where the net return was zero. So it is as uncorrelated as that. I mean, even month to month, if you see, even at a time, as I said, when the mutual fund industry did not exist in any meaningful fashion at all, there was no correlation. So I think it's a fool's errand to really try to forecast FII flows and from there try to gauge where the market would go. That's what the data says.
Yeah, no, I absolutely take the point, Devina. But the only thing is that, I mean, we can never tell, never predict. We're only wiser in hindsight. That point is taken, Devina. But the point is, can locals continue to pump in this kind of money? Will it continue? Is it a secular theme? And if not, I mean, in anticipation that flows will remain so strong, supply is also building up on the other side, right? Big supply. So right. I'm trying to understand whether is it going to be evenly matched? Will demand overwhelm supply? Because you go back, you get the 90s example. I think we've had bull markets punctured by too much supply. I think that 94 instance was, I think is a case in point. So just your thoughts.
So, I mean, that was not just that there was too much supply of paper, but, that's a different question altogether. In fact, I wrote recently about the IPO market, and that definitely looks to be in whatever you should call it, frothy or bubble territory. There's no doubt in the SEBI data, which actually is only up to December last year, already showed that more than half the people who get an allotment sell in the first week. And if the issue lists at a premium to the IPO price, something like 67% of the people sell. I'm sure the proportions are even higher now. So it's not become a game where you're not investing in the company because you think the valuation is right. You are investing because of what is called in finance the greater fool theory, that you will find a greater fool who will buy it at an even higher price from you. So that's always dangerous because, then everybody thinks that they will, even people who think, let's say an IPO is too highly priced, they will still go in thinking this is a lottery. If I win it, I will get out at a profit. But that sort of thing always ends badly because everyone thinks they will get out ahead of the mob, ahead of the dumb money, as they say. But till you find you are the dumb money. And I've given the example of Isaac Newton, the same scientist all of us heard of in school. And in spite of being not just a great scientist, he was also a finance person. He was a master of the Royal Mint in England. And yet he lost almost all his fortune in a bubble called the South Sea Company bubble. And he saw that this was overpriced. At one stage, he got out of the stock, and then again he bought it at a higher price and then rode it all the way down. So, so there are areas in the market which are fraudy. And IPOs are one. The other rule of thumb to identify fraudy areas is to see where the thematic funds and schemes are getting launched.
Oh, let's not even get started there. Devina, hi, morning. Surabhi here. By the way, your green, the green of your attire is, I think, reflecting the mood of the market. It's a bright shade of green across global markets. We've got rate cuts pouring in. So, but I guess that's the thing with momentum, right? And not just thematic funds. Now you have momentum funds launched by so many AMCs, and it's just the nature and the mood of the market that we're in. But yeah, who's to say where this goes? Till the going is good, it's good. And for a lot of people who came in after COVID, I think it's 3 years of an up market, and now you get into a rate cut cycle, and everybody's still saying that it's still looking good. So anyway, the point is, let's talk about...
We talked of people coming late. So that same SEBI study also said that I think 85% of the IPO allotments are to accounts which have opened after 2016, and more than 50% are to accounts which have opened post-COVID. So they have not seen the cycle.
No, they haven't seen the cycle, and now when it turns, it turns. But let's talk about what to do here and now. And what we're seeing in the market is a little bit of at least change in positioning, some sector rotation. That whole idea of buy any PSU stock and it'll be a doubler, I think that's coming under a bit of question now. So what is it that you're advising? Are you changing anything in your portfolios in terms of themes like CapEx and industrials and manufacturing? Do you think it's time to get into banks? But the bank trade really has been a bit of a non-starter. I mean, we're all waiting for that major secular up move in bank stocks, but it hasn't happened so far.
Okay, so in terms of the sector, of course, we will be doing our quarterly rebalance in something like 3 weeks' time. So I might have slightly some changes there. But as where we stand today and based on what we have done up until now, our biggest overweights would be things like pharma, auto components. We've gone somewhat overweight IT in the last rebalance. Cap goods and industrial machinery, most people discovered in 2023. We have been overweight for almost 3 years. So we went overweight in October 21. So, I mean, now we've been cutting. So we've been, because many of those stocks did so well. So, we are now, we've been marginally overweight, but we're now close to market weight. And as far as, in general, what is to be done? First of all, many of the viewers would have made great money in some small cap, some micro cap. All those things you book profits and put it into a steadier portfolio. So if you want a one-line advice, that would be it. Banks, I mean, while they've underperformed a lot, if you look at the longer term, maybe they may not underperform that much, but that's not a sector that's a thumping buy, especially with all the credit concerns also. That's the part which you don't know, where that credit cycle to retail loans in particular, where that cycle will turn. And as people tell me that you repeat this in most interviews, I'm a nervous investor in banks and lenders. And that's because you don't know where the negative surprises hide in that sector. So that's definitely not a sector that I'm recommending as a switch to. I told you what looks good. I mean, we're watching FMCG. That's one place where little by little, weight has been going up. And I think it might be a positive cycle for FMCG earnings because the cost side, the food-related costs are going down, oil-related costs are going down, which are the main inputs for the FMCG pack.
All right, take your point on the sectors which you're overweight on and building positions on some which you are nervous on as well. But, like we were talking about, how a lot of the investors currently haven't perhaps seen a cycle itself. So, from your wisdom, what, according to you, would be, the first signs of worry? What would be the, the proverbial canaries in the coal mines? Largely because everyone knows that some parts of the market are frothy. Everyone knows that some parts of the market are, showing signs of value. But every time it turns, people are still surprised. I mean, case in point, Everyone's surprised by the decline that we've seen in a lot of these PSU stocks. Everyone's surprised by the fact that some of the large caps are actually doing well. Everyone was surprised by the decline that we saw in the mid-cap index yesterday as well. But for the last 2 months or so, everyone's been calling out the top at the mid-cap end of things. So while everyone likes to call out, not a lot of people act on it. So what would your advice to them be, and what would be the first signs of, worry emanating?
So normally, I mean, the risk is what you don't foresee. So the trigger might be something you don't foresee sitting here. That's the whole point. But I'm not surprised that the large caps are going up or so on. So I mean, that's a bet that we took a few quarters ago to be away from the small cap and the really small cap and the sub 5,000 crore market cap, small cap. And even though we knew that we could see the momentum, we could see that in the short term it would hurt our performance, but you should never as I said, bet on getting out ahead of the crowd. So you cannot wait for a trigger, and you will not know in advance what the trigger would be. But just let me give you a few statistics on small cap. So the small cap index in 2008-9 fell nearly 80%. 78% to be exact. So, I mean, if you haven't forgotten your school maths, if something falls 80%, it goes up 5-fold, you are still at zero. So that increase came after 8 years in 2016. That high was crossed, but that's a theoretical statement because the index was a completely different index from what it was in 2008. So many of the stocks which fell in 2008 never came back. So that's the danger in small cap, micro cap, that stocks just disappear into the blue yonder. Many more stocks have been listed in the Indian markets than currently trade now. So, less than 50% of them actively trade. So, and again, there was a mad bull market from that 2016 to 18, about 1.5 years. Again, the small cap index fell nearly 2/3. And now a lot of the micro cap managers who say that 50% compounding for 2 years or 3 years, remember, something falls 80%, it compounds 50% for 3 years, you're still down 33%. So those are the numbers to remember. If you haven't lived through the cycles, as they say, learn from your mistakes, but the smarter person who is the one who learns from the mistakes of others and doesn't forget history.
All right, doesn't forget history. But, hanging there on a lighter note, we're getting some visuals coming in from the Apple store in Mumbai out here. It's September 20th, which means that the Apple iPhone 16, 16 Plus and all, would be available for sale. And as it is around the world, people queue up for those phones as well. These are not cheap phones, 90,000 rupees to 1,30,000 a pop. And there are a bunch of people queuing up for that as well. Devina, people who would have made profits in some of these IPOs are perhaps, very excited to take those profits out and buy iPhone 16s. You are also investing in global stocks. So what are your thoughts on Apple here? Just out of curiosity, I want to ask, and will you be buying the iPhone 16?
I haven't bought a single iPhone. I'm still on Android. So I'm the wrong person.
Did you buy the Apple stock?
So, yeah, I mean, we have some exposure, but less than market weight. So we would have something, but not.
Then you're not a true loyalist. You're using an Android and buying an Apple stock. I mean,
no, but that's what I'm saying. I'm not even at market weight on Apple. In fact, we didn't hold Apple in the middle. Now I think we have a small holding, but yeah, so I'm happy with Android. I'm happy with the Google Voice to Text in particular. So I wrote my entire book on on my phone. So I have no
Are you tracking the developments at Nike? New leadership emerging out there as well. The stock has been in the doldrums. Stock is up around 8%.
Whenever the stocks are in the doldrums, you keep trying out new CEOs. Happened with Starbucks also. And so, I mean, that's the way US works. So, let's see what happens with the change.
Right. Prashant, you're buying the iPhone 16?
I'm using my latest iPhone 13.
iPhone 13. That's not too bad. That's not too bad.
Before this, I was using the latest iPhone 6. So I
guess the iPhone 26 is what you will go for.
About 5 generations behind. Devina, great speaking with you. Thank you very much for your time. Appreciate it here on CNBC TV 18, as always. Wonderful. Thank you. So that's Devina Mehra with perspective on markets.